Hi traders, welcome to the first edition of the new year. This is Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Also, I'll just let you have a look at the disclaimer. I'll just run through some of the key objectives of this webinar. We think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These stories or narratives can be long-term fundamentals or short-term themes that increase or decrease in importance over time. So in this episode, in this first webinar of the year, we'll look at how markets are shaping up currently on the second full trading day of 2024. We'll then just check out a couple of themes that we're kind of looking at and monitoring to see how price action and how markets will react to actually some sort of previous themes from last year, those overriding themes about interest rates generally for markets, and then also a second theme around the Magnificent Seven tech stocks. That will lead us on to a quick look at technicals in the US major indices, so the S&P 500, the Dow, and the Nasdaq. Before then, looking and getting straight into the main event of this week, which is non-farm payrolls. We'll review that with a graphic of the main numbers and look at what markets may do. We'll then briefly touch upon some of the other quite interesting, important data actually out of the US this week. We do have ISM manufacturing and the Fed minutes from that pivot meeting, if you like, in December, which come out later today as well. We'll then look at the other main data point risk event of the week, which is eurozone inflation. Again, we have a graphic with the main numbers, and we'll look at euro dollar as well, and hopefully then, if we do have time, look at the Canadian jobs report as well, which would be important, of course, for dollar CAD, which we will look at. Okay, just seeing how markets are generally trading at the moment. Yes, well, yesterday's first session of the year actually characterized really interestingly by markets, not some major news catalysts, but markets really lowering their expectations for rate cuts in 2024 this year. Rising yields really then provided headwinds to equities, particularly tech stocks, which fell more than 2% for the day, with a tech-heavy Nasdaq actually dropping the most in more than 2 months. Asian and European stocks trading lower today, of course, following those losses on Wall Street. Then oil prices, interestingly, rose in the early hours of this session following Iran's decision to deploy a warship in the Red Sea. Those gains were erased amid interest rate jitters and risk-off sentiment really outweighing that geopolitical uncertainty. The Brent actually ended down by some 3%. Gold, interestingly, holding support just around 2055 or so just off on the day, but still holding that support. Markets will be watching any signs for weakness there is a US jobs opening data report out today, the JOLTS data ahead of course, Friday's non-farm payrolls. And then, as I mentioned, we do have that ISM manufacturing and also the Fed minutes later on this evening. The dollar has rallied versus most majors as Treasury yields rose. Traders, interestingly, unwinding some of their dollar shorts actually after futures positioning. Really, they increased their short positioning in the speculative and institutional report. That was up to December 26th, I think, that fresh report showing that shorts had increased their positioning to a 4-month high. So probably some unwinding of those near-term shorts by speculative money for sure happening over the last 24 hours and in the first trading session of this year. I just want to get on to, first of all, then a look at those interest rates and Treasury yields. We don't often go into this too much because we can't really trade 10-year yield as well as we would like to probably, but just really interesting because obviously interest rates were the big swing factor in 2023 as rate rise fears first grew, of course, then receded in the March banking turmoil, then returned in the summer before fading in the last 2 months. And we can sort of see that in this chart here, with obviously that banking crisis and yields coming off, bond prices going up. And then we sort of touched around 3.32. We've got it here actually from the low in early January, but then that big rise, ascending channel, higher highs, higher lows, up to 5%. And then in the last couple of months, we've seen a very, very sharp sell-off in yields, a strong bid in equities. And we're sort of down, we got down to 3.78%, and we're just now below 4% on the US 10-year Treasury. We look at this because it is really known as being a global proxy for borrowing costs. So that is why this is important to watch out for. It will direct the dollar and it will direct many other markets. So just having a guide to where you think this might be going is key really for most markets that we then go on to trade. But interest rates, yes, so the key factor. Interestingly for us, it was a bit of a head scratcher really, because stocks track bond prices and thus move inversely to bond yields. But that is what happened over the last year or so. Stocks tracking bonds, and as I say, moving in the opposite direction to bond yields. That's really upended a sort of decade-long pattern of the relationship between the two. Essentially, when markets are not worrying about inflation, rising yields signal better growth, and that's great for equities. But if in inflationary periods, they're often a sign of reigniting inflation, and that's negative. And in 2023, really, the bond market basically jumped into the driving seat, if you like, for the equity market. So key going forward is whether this shift lasts. Markets will have to think carefully really about what bond yields are really saying. And a lot of people are asking these questions now. So this slide that we've seen in these yields from 5% in October to below 4%, that spurred this rally of around 14% in the benchmark US stock indices, the S&P 500. So really it's a question around, are lower yields signaling easier financial conditions because of this disinflation process, because of falling inflation, which means that will buoy and keep economic activity buoyant, if you like, and corporate earnings as well. And then that will help, of course, with the consensus calls around a soft landing and the sort of Goldilocks environment, not too hot, not too cold, and the Fed can start cutting rates because inflation is falling, and it won't bring on a recession or a harder landing, if you like. The other question, though, on the flip side really is, should then these falling yields really be seen as expectations that bond investors really expect growth to slow markedly with this recession and potentially more? So really then pricing is more downturn driven as opposed to disinflation driven, if you like. Those are the key questions around the bond market, and the bond market is an important market which then leads other markets as well. That's one theme we think is very important at the moment. Otherwise, the other one is certainly then around the Magnificent Seven. And you can't really fail to have reviewed or looked at 2023 stock markets really without obviously looking at the Magnificent Seven. Tech stocks, they accounted for more than half of the S&P 500's gains this year. Those last year, sorry, those were around 24%. In early summer, actually, they were even more dominant, accounting for all of the index's gains. And you can just see here on this chart, the S&P obviously up around 24%, as I said, on the year. Very, very good year, but that's principally driven by these 7 stocks. And you can see, well, the worst of them, Apple, gaining around 40-odd%. And then Microsoft, Alphabet, Amazon, Tesla, Meta, and then Nvidia with stellar gains of around 240% or so on the year. Of course, what was this all down to? Well, if we think back, it was after March that their dominance really started to grow, and then late in May, Nvidia's strong earnings kicked off the really growth focused search, if you like, for stocks with links to AI, with artificial intelligence links. And of course, tech investing is all about growth stocks. And then these themes tacked on, such as AI and other catalysts, which then spur another leg higher in these stocks. So really interesting now. The question is, of course, whether this can continue, whether then we've seen sort of AI peak out somewhat and we'll just get smaller marginal gains across and take longer, or whether, of course, yeah, as I've said, this continues. And then the Magnificent Seven potentially are looked at in other ways, especially if we get a slowdown in the economy. These are, of course, are mega cap, huge companies that aren't reliant on especially struggling banks or volatile capital markets, and can or could potentially be seen as more defensive. So that is a question maybe for fund managers, but also it's a question for investors and for traders about how these stocks will be seen going forward, whether they're growth stocks still or whether they should be put in the more defensive side of things. That will be key again for how stock markets perform going forward. Generally then, just looking at stocks overall, then moving away from those two themes. Well, global stock markets, of course, they recorded their strongest year since 2019. That blistering 2-month rally we saw in November, December, really investors betting big that central banks have finished raising rates now and will cut them rapidly next year. The MSCI World Index, so that's a broad gauge of global developed market equities, that surged by 16% since late October, up 22% last year in 2023. That's his best performance, as I said, for 4 years. Largely, though, of course, if we touch on, fueled by the S&P 500, that's risen 14% since October, and 24%, as I said, on the year. If we just, we're just going to pull up the chart actually, which I'll come to now, the weekly chart at least. Yes, we ended last year, of course, just shy of that all-time record gains, driven, as we said, by that dramatic shift that we've then seen in interest rate expectations, following really a bunch of recent data showing inflation falling faster than expected. And then, of course, we had that subsequent Fed pivot in December. So this is the S&P weekly chart. You can just see then the fall in the S&P, down 0.57% on the day yesterday, and just below that all-time high at 48.18. So really strong resistance, you would think, at that record high, and we've just turned lower. Probably next support, initial support now is not to down to, well, that breakout level which we got here from the March high, which is 46.37, and then you've got these highs from July, late July, around 46.07. On the daily you can see it better, just that roll over there. 3 now consecutive down days, and as we say, initial resistance support, sorry, probably 46.97, 4700 just here, the recent lows, and then before that, below that, 46.37 would be the levels we're looking at. But remember, 9 straight weeks of, let me just pull up this actually, just to show you. Nicely done by somebody on TradingView. 9 straight weeks of gains. That has not been seen, well, the longest run since the beginning of 2004. So yes, kind of figures that we will get some sort of retracement. If you see on the daily, we're very, very overbought as well, and we've had negative divergence really between the RSI, sorry, not making a higher high, but prices making a higher high. So yes, inevitably we think you get some turn down here, and it's just whether these support levels then hold. If we look at the Nasdaq, that did break higher. Above the all-time high at 16,764, we got up to the high of 16,969, so just shy of 17,000. Then of course we turned lower. This is on the weekly chart, and then if I go to the daily, yeah, you can see that previous high 16,764, and then a couple 3 days now turning lower, and you can just see that Santa rally in effect happening. A couple of down days, but really multiple green days. Of course, the Santa rally, I guess, is between Christmas and New Year, and then the first 2 days in this new year. So just giving back a lot of those gains, in fact, which is interesting. And we'll look at that actually on a historical perspective in due course. But yes, first support level, possibly this fib level near term 16,282, and then probably around 16,000 and just below, probably better support on the Nasdaq 100. The Dow, that as well, similar chart, powering ahead, consecutive weeks of gains. You can see there, and getting up towards where 37,790 was the high, and then we've just rolled. Well, we did roll over. Yes, the final day of last year, but then interestingly, obviously, very few zero tech stocks in the Dow 30, and that held up relatively well. If you think that the Nasdaq was off 1.7% or so, the Dow actually eked out small gains. So just consolidating near those highs, which is interesting as we go into some of this big data that we're going to see in the next few days. Okay, let's go to the big event of this week, of course, is non-farm payroll report. We have the graphic here, which is what I mentioned before. Of course, the health of the US job market is crucial to gauging whether this Goldilocks scenario continues into 2024. That really puts this December non-farm payroll report fully in the spotlight. Economic growth has cooled, inflation has eased, and of course that has then fueled this massive cross-asset rally we've been talking about, and then that has also then allowed the Fed to pencil in rate cuts for 2024. Also means focus will certainly be now moving potentially away from inflation slightly to the Fed's other part of their mandate, which is, of course, employment. And really interesting, of course, that there is, although the economic growth is cooling in some measures, the evidence of a sort of downturn in the employment is still waiting to be seen, really, even though obviously the headline figures are moving lower. Just on this chart, first of all, you can see that the growth is expected. Slower growth in the headline number, which is this bar chart, and then you can see average earnings, the red line, cooling slightly, and the unemployment rate as well, just picking up slightly, but still very close to all-time record lows. And if we just go back to the graphic, so yes, market is expecting around 168,000 job gains in December. That's versus 199 in November. Unemployment forecast to tick up modestly to 3.8%. And yes, the Fed's latest projections, they saw the jobless rate at 3.8% as well, and then 4.1% next year. And then earnings, they are still seen as fairly benign, really. Unlikely to rock the boat, 0.3%. And that would be actually, well, a slip from 0.4% previously. That was 0.4, the fastest pace since July. And then the annual rate dipping 1/10 as well to 3.9%. Markets now, well, this has changed slightly. There was around an 80% chance of a 25 basis point rate hike at the Fed March meeting, now down to sort of 75% or so. We always think above 70%, the Fed will not want to rock the boat with markets. It's kind of a benchmark, if you like. We're now around 75% for that 25 basis point cut in March. Interestingly, there's still around 150 basis points of rate cuts for the whole of the year, so that's 6 25 basis point rate cuts across the year. And we must remember, of course, the Fed's current projections are for just 75 basis points of cuts So markets projecting double that amount, and you've seen that, of course, in the last day or so, just a pulling back in slightly of that, and potentially this data will have a major impact on whether these rate bet cuts, if you like, rate cut bets even, yeah, are reined in again after this data. Certainly then, yeah, given that strong conviction about the Fed meant to be slashing rates soon, kind of a small beat or miss in the headline, probably unlikely to generate anything too much in reaction in the markets. Possibly, some economists are saying a very disappointing report isn't that likely because jobless claims, the weekly jobless claims numbers have been quite low during the period. If there is a shock, then it's probably with an unexpectedly hot report. We like to think of it as in good news is bad news, if you like. So if we get a good, strong jobs data report, job gains strong, average hourly earnings ticking up possibly, then that is bad news for risk markets. Conversely, of course, the dollar could then jump along with higher yields. And as we say, risk markets, Wall Street could possibly succumb to some selling as investors basically scale back those rate cut bets on the upbeat readings. We shall see. It's very tough to forecast the headline rate, especially, but it's probably we do probably need an outsized report to generate a major market reaction. We mentioned other data as well. We've shown you this chart, but other data today, ISM manufacturing, and then we get ISM services on Friday as well, plus then the FOMC minutes later tonight. Those minutes, as I said, from that pivot meeting when we saw a change in the dot plots. So what the Fed essentially removed that extra hike for 2023. That was a given, and then guided an extra 25 basis point cuts for this year. So as I said, 75 basis points in total versus 50 in the previous dot plots. This is the median dot plot, of course. Interesting for us, markets kind of believe there's a broader consensus on the FOMC in favor of easing. So dialogue around this will be key for us. If you just think about those dots, probably not many of you have checked them out in detail, but just around this idea of a consensus, well, only 6 out of 19 dots have 75 basis points, 4 have 100 basis points of cuts, 1 has 175 basis points of cuts, and then on the flip side, if you like, 5 members have only 50 basis points of cut, 1 favors 25 basis points of cuts, and 2 say there should be no easing at all. So it's kind of not a great consensus there. You'd like to think. 2, just to repeat, 2 saying no easing at all, but 1 saying 175 basis points of cuts, please. And then everything in between, which is 19 members in total, so, or 19 dots. So yeah, really key will then be how diverse are the range of views, because they're evidently reflected in that diverse dot range, you would think. And then how broad really is support against premature easing, which is obviously something that Fed Chair Powell really did mention, and markets then latched onto this idea that they were talking about easing, and that was part of the meeting. Yes, whether there is less support for that, and potentially we've seen some pushback, but certainly these meeting minutes will be of interest. Yes, otherwise I mentioned just going back actually, the data today, ISM manufacturing, December's probably likely to extend the sector's contraction to 14 consecutive months, with new orders shrinking for probably 16 straight months. That's since the initial pandemic rebound began cooling on the good side of the economy. Then, as I say, Friday, ISM services the question is, can December's reading sustain the momentum seen in the prior November report, with evidence of accelerated growth in the services sector? just checking where we are now. We'll just look at the DXY actually now, which is obviously the dollar index, a key index, and widely followed. Just take with a pinch of salt that we're up over 1% today. Just these couple of candles, I think, are slightly erroneous when you look at, say, euro dollar and sterling dollar, for example. Euro dollar only down 0.15%. And that is around 56, 57% of the DXY. So it looks slightly odd to me. But anyway, we'll just look at the DXY, of course. You can see we got down to that low, multi-month low last seen in sort of July time at where 100.61. And then we just had a couple of days, strong days. That should be a green candle effectively. But yeah, a few consecutive days of gains now. We're probably still in this channel, which is probably something I should put on there just to see, as long as I find it, which is here. Yeah, we could just be edging towards the top of the channel if you put it roughly. It's always good to have at least 2 points touching the lines, but yeah, you can see there lower lows, lower highs, and then we're just up to the top of this channel. We got there before, you can see, and then fell quite sharply. So yeah, interesting point for the dollar. We've got up to that sort of low November low as well. 102, where are we? 102. 46, we're just below that now at the moment, 102.44. So that'll be interesting, initial resistance. And then potentially if we do break out of this channel or not, then we've got the 200-day moving average at 103.40, well above. Otherwise, we fall back down towards potentially 101. So that's the dollar index. Let's move on now to the other big risk event for us, which is eurozone inflation. That's out also on Friday. We have another graphic here, which you can see. Headline forecast to print higher in December for the first time actually since April. It's seen jumping to 3% from 2.4% in November, basically snapping a sharp drop, which saw, well, HICP undershoot expectations for 3 straight months. The jump down to energy support measures a year ago, especially in Germany, where the government basically covered household gas bills, meaning there was a lower base to which December 2023 prices are compared. December is normally a seasonal up month for price pressures, but then weighing on this prospect possibly is that gasoline prices continue to decline in December over November. There is good news though on the core front that obviously strips out volatile food and energy prices. This is more, well, the ECB officials focus more on this number than the headline really, and that's expected to drop, or that continued drop is likely from 3.6% to 3.4%. That would be the lowest since March 2022. You can see there the last 3 months have all put in actually seasonally unadjusted readings that have been softer than like months in history. So if that continues or not, well, is the key question really for the ECB. They have pushed back against rate cuts, markets pricing in the first cut sort of March, April time. But ECB officials have pushed back over the last few weeks against that, and they are really concerned, quite concerned about high wage pressures and then high inflation expectations, as well as some of the geopolitical events as well. For example, those supply chain issues related to the Suez Canal. So that is eurozone inflation. You can see that on the chart as well. The bright blue line is the headline, obviously falling sharply, but then just ticking higher because of that base effect with government support on energy, household bills. And then you've got two versions of core, less energy and food, and then less energy, food, and tobacco and alcohol. Both all falling, or those couple anyway of core readings falling, which will be encouraging for the ECB, but still above the 2% target, of course, which is their, yeah, as I say, official target. If we just look at Euro dollar now, you can see sharp drop, yeah, from those highs of 111.39. We had that just before the end of the year last Thursday. 111.39 turned lower now, 4 consecutive days of selling, and we're probably through that. We've got in here the fib level of this summer decline. We had the 61.8 at 109.59, but that's going up, in fact. So I'll probably switch that around, but the level still holds. So 109.59, we're through that now. So the next level is around 108.62, which is the halfway point of the summer rally. That still holds, of course. And then just below there, interesting, we've got the 50-day crossing through and up through the 200-day moving average, golden cross possibly, but that is lagging, so potentially is a sell signal as well, and you've certainly got that over the last 4 days or so. But the 200-day moving average, that sits at 108.45, the 50-day at 108.48. So that's euro dollar, and a few levels to look at as well. Just briefly, we'll touch upon actually, well, just before we look at we'll just look at Canada jobs data as well. But yes, euro, well, it's held up remarkably well actually through 2023 because of the plies of the region's economy, of course. As I mentioned, ECB officials kind of held sway for large parts with their sort of hawkish stance, essentially. And it'd just be interesting now whether we get a recession or not in the eurozone economy, and then whether then potentially the ECB, even after their pushback against premature rate cut expectations and risks, become bigger in the eurozone than those of keeping monetary policy tight for too long. That making then policy less restricted by the Fed would also mean US growth converges with the stagnant eurozone. That's a question really, whether the Fed or the Europe actually, sorry, the US comes growth dynamics do come lower eventually and towards the eurozone, or whether the eurozone remains stagnant and possibly worse. Okay, over just quickly to now dollar CAD, which you can see here. We do get those jobs numbers on Friday as well, at the same time as the non-farm payroll report. Consensus sees 13,500 job gains and a small uptick in the unemployment rate to 5.9 from 5.8%, really as the pace of labour force expansion through population growth is likely to continue to exceed job growth. Key will also be wages that have been rising quite strongly, really, including that re-acceleration we saw in November. All in all, though, last year, just recapping, was a very strong year for job growth, around 430,000 jobs so far, with obviously this month's to add in, or last month's report to add in. Most of those as well, 350,000 or so full-time. And unemployment has been relatively stable as well, certainly below the year-end consensus call for 6.5%. I think it's averaged around 5.75%. So really, the question is, can this resilience continue into the new year? And of course, the loonie, the Canadian dollar, will be watching this data as rate cut bets kind of followed the Fed for the Bank of Canada, and they've been ratcheted up lately. The dollar, Canadian dollar, that is, did better than some of the other commodity-linked currencies. I think it gained around 2.5%. In 2023. Yeah, so better than the Kiwi dollar, which was down actually against the dollar, and the Aussie dollar just very small up, I think. Certainly less exposure to China, and then more unquestionably probably a hawkish stance by the Bank of Canada contributed to its relative outperformance. So that'll be interesting to see what happens going forward, of course, in 2024. Certainly if the stagnating economic sort of growth spreads and then forces the Bank of Canada to start lowering rates in line possibly with the Fed, then the loonie may struggle. You can see fifth consecutive day of gains now for the dollar against the CAD. First probably level of resistance 134, so quite high up really, 55 pips or so away. That tallies with that swing low there from September at 133.78, so around that level for the sort of major resistance. Otherwise, strong support around 132 in dollar CAD. Okay, we'll wrap it up there. Hopefully that's proved of use to you guys. Great having you on the call. Best of luck this year, of course, and a busy first week to look forward to. We do have as well next week on the calendar US CPI to look forward to. That'll be a key event next week. But all the best for the start of this new trading year, and we will speak to you again in a couple of weeks' time. Take care.